Sable Offshore Corp massively missed Q2 2026 consensus across the board.
Completely missed it.
Yeah, the actual earnings per share came in at negative 22 cents against an expected profit of 32 cents. I mean, that is a staggering 230% miss.
Right.
And the revenue miss was just as brutal. They posted 137.1 million actual versus the expected 220.85 million.
It's a massive gap.
It is. Plus, management slashed their second half 2026 midpoint capex by 41% down to 85 million and guided for a midpoint of 152 million in unlevered free cash flow for the back half of 2026 into 2027.
And that's assuming $75 Brent crude.
Right, exactly.
Yeah.
And the market reaction was swift. The stock fell 13.26% in after-hours trading, dropping from $5.09 straight down to 4.400 on first ounce.
Okay, let's unpack this.
Yeah, let's get into it.
Because those numbers look like a complete death spiral at first glance. But if you actually sit down and read the SEC filings alongside the Wall Street analyst notes, you'll see both analysts and management are still pointing to a highly lucrative long-term setup.
Which sounds crazy, right?
Yeah.
It does. So for you listening, our mission on this deep dive is to reconcile these two completely opposed realities. I mean, how is a stock crashing 13% while the underlying commentary remains incredibly bullish?
Well, to figure out what's really happening with Sable, you have to mentally split the company in half.
Okay, how so?
You've got the physical reservoir's performance deep underground, and then you've got the logistical nightmare happening above ground.
Ah, right.
That is literally the only way to read this quarter, because the income statement looks like a disaster zone. But if you look at the physical assets, the actual oil wells, they're wildly overperforming.
Yeah, we have to draw a hard line between what the San Ynez unit can physically produce and what the local infrastructure is actually allowing them to sell.
Right, so let's start with the physical asset, because this is where the narrative completely flips from the financial headlines. Sable successfully restarted Platform Heritage in April of 2026.
Right. And by the time we hit the end of Q2, they reached an exit rate of 40,000 net barrels of oil per day. That's a 149% entry-to-exit growth rate for a single quarter.
And honestly, that speed is hard to overstate.
Yeah.
Think about the engineering reality here.
It's massive.
Right, restarting an offshore platform that's been sitting dormant out in the Pacific, it isn't a matter of just, turning a giant valve.
Yeah, it's not a faucet.
Exactly. You're dealing with immense hydrostatic pressures, complex subsea tiebacks, and decades-old infrastructure. So ramping from 0 to 40,000 barrels a day that aggressively, it tells you one thing.
Which is?
The sheer pressure and the quality of the reservoir under that ocean floor is phenomenal.
And CEO Jim Flores clearly knows it. On the earnings call, he didn't mince words. He called the field's performance spectacular.
He really did.
And he pointed out a metric that, frankly, completely caught me off guard. He said these wells are showing virtually zero decline rate right now.
Yeah, that's wild.
If you follow the oil and gas industry, you know zero decline rate is almost an oxymoron. I mean, the second you tap a pressurized reservoir, the pressure typically starts dropping.
Right, and your production volume starts ticking down with it.
Exactly.
Sure, I mean, the basic physics of fluid extraction dictate a decline curve, but you have to factor in the sheer scale of the San Ynez unit, or SYU. The footprint is just massive.
How massive are we talking?
We're talking about a field that still has 1.5 billion barrels of primary forecast reserves sitting trapped in the rock. It's literally the #1 field in the United States based on estimated recovered reserves.
Wow.
And because that reservoir is so vast and the subterranean pressure is holding up so well, Sable is heavily utilizing a technique called perf adds perforation additions.
Let's talk about the mechanics of that, because I saw it highlighted in their filings.
Yeah.
Instead of drilling an entirely new well, which, costs a fortune, they're going up hole in an existing well bore, right? Just punching new holes in the steel casing and accessing fresh oil zones that were previously bypassed.
It's an incredibly capital-efficient way to maintain volume. They're targeting these perf adds at a cost of roughly $800,000 per well.
Which is nothing.
In the grand scheme of offshore drilling, it's practically pocket change. And for that $800K outlay, they anticipate an incremental 600 gross barrels of oil per day from every single one.
That's a massive return.
Right, and the early data is validating the strategy. The physical extraction side of Sable's business is effectively running in a best-case scenario.
Okay, I have to stop you there, though.
Sure.
Because it sounds like they've successfully turned on a fire hose of crude oil, but they only have a garden hose to catch the water.
That's a good way to put it.
If the oil is flowing perfectly and the perf adds are working and the pressure is holding, How on earth did they miss their revenue target by over $80 million?
Yeah.
I mean, that's a canyon-sized gap between the physical reality of the wells and the reality of their income statement.
What's fascinating here is that the bottleneck isn't getting the hydrocarbons out of the seabed. It's the immediate chain of events the second that oil hits the surface.
The garden hose.
The garden hose analogy is spot on. Sable is running headfirst into severe third-party sales constraints and downstream bottlenecks.
Meaning they can't sell it.
The oil is flowing, but they physically cannot move it all into the broader market. The pipelines and local refineries couldn't absorb the volume fast enough.
Right.
To the point where Sable was forced to just pump crude into their 540,000-barrel onshore storage tanks until they basically reach capacity.
Man, if they're backing up the system like that, they're definitely paying a premium to get rid of the crude.
Oh, absolutely.
That explains why Q2 revenue was shockingly light. They were bleeding cash just trying to push the product through a choked system. And they're currently swallowing a massive $30 per barrel discount on their crude as a result.
That $30 discount is the anchor dragging down the entire earnings report.
It's huge.
Yeah, and when you look under the hood of that number, it breaks down into 3 distinct $10 penalties.
Okay, lay them out.
First, they're getting hit with a $10 per barrel sulfur penalty.
Right.
Then, a $10 per barrel demurrage charge.
Ouch.
And lastly, about $10 in basic transportation and refinery differentials.
Let's focus on that $10 demurrage charge because it resulted in an $18.5 million non-recurring hit in Q2 alone.
Yeah.
They absorbed an $18.5 million penalty just from tankers being forced to sit idle at the dock, waiting to load or unload.
And the mechanism behind why those tankers were sitting idle, that's tied directly to the very rigid California refining environment.
Right.
Think about how a modern refinery operates. It's not a giant pot where you just dump any oil you find.
Yeah, it's chemistry.
Exactly. Refineries operate on highly calibrated, meticulously planned schedules requiring very specific slates or chemical profiles of crude. So when Sable ramped up to 40,000 barrels a day so aggressively, the local California refineries simply couldn't adjust their long-term import schedules fast enough to take the SYU crude.
So they literally had to abruptly displace imported cargoes of oil to make physical room in the system for Sable's new production.
Precisely. To compensate partners like Chevron, for example, for the sheer logistical chaos of turning inbound marine tankers around or making them wait offshore, Sable had to eat that $18.5 million in demurrage.
Wow.
They paid the penalty for disrupting the local supply chain.
Which, just to be clear for you listening, is a factual constraint of operating in California. The state has a notoriously strict regulatory environment with very hard physical limits on pipeline capacity and refinery optionality.
That's right.
But management claims they have a timeline for relief. On the call, they pointed to the restart of Platform Hondo in September as the critical turning point for their margins.
Yeah, Platform Hondo is the linchpin for fixing the crude quality issue, which attacks that first $10 sulfur penalty we talked about.
How'd that work?
The SYU field is geographically interesting. The platforms on the western side of the unit produce a heavier, higher sulfur crude.
Okay.
But Platform Hondo, sitting on the eastern side, produces a much lower sulfur crude. Because Hondo hasn't been brought online yet, Sable's current product mix is skewed heavily toward high sulfur, triggering that hefty refinery penalty.
So the mechanism is just basic blending. Hondo comes online, they mix that lower sulfur crude into the field's overall stream, the average sulfur content drops below the penalty threshold, and they instantly claw back margin.
That's the plan. Management expects this blending effect, combined with some specific chemical treatments they're testing at the facility level, to shrink that overall $30 discount down to $20 by the fourth quarter.
Here's where it gets really interesting, though. Management is eagerly labeling that $18.5 million demurrage charge as non-recurring. They're waving it off as a one-time startup friction cost.
Right.
But given the persistent pipeline limits and the heavily localized downstream market in California, should you really believe that these logistical costs will just magically evaporate by Q4? I mean, assuming the local supply chain is going to flawlessly absorb 40,000 barrels a day without any future friction, feels wildly optimistic to me.
I wouldn't take the non-recurring label at face value either.
Yeah.
While the specific demurrage fees related to aggressively turning tankers around might fade as Chevron and others adjust their delivery schedules, Sable's overall marketing economics are completely chained to those local refinery slates and the successful on-time restart of Platform Hondo.
And Hondo isn't exactly new.
No, remember, Hondo is a 45-year-old offshore structure. Management openly admitted on the call that it required about 50% more restoration work than they initially forecasted.
Wow, 50%.
Yeah. So if Hondo's September restart slips into late Q4 or next year, that sulfur penalty continues chewing up their cash flow. If the onshore pipelines hit max capacity again, the margin bleed continues.
They are trapped in a localized market with very few buyers.
Exactly.
Well, if they're bleeding $30 a barrel on local refinery penalties right now, their cash flow is wrecked.
Huh.
Let's look at how they are physically keeping the lights on to survive this bottleneck, because it leads us straight into the highly aggressive debt restructuring they just finalized.
This is where Sable's story shifts away from mechanical engineering and becomes a masterclass in financial engineering.
Yeah.
In July 2026, they executed a massive refinancing transaction. The primary objective was to entirely retire the original seller note held by ExxonMobil.
Retiring that Exxon note was an absolute necessity because it alleviated the going concern doubts that auditors had slapped on their filings.
Huge relief.
Yeah, when an auditor flags a company with a going concern warning, they're essentially telling the public, hey, we have serious doubts this company will even exist 12 months from now. Wiping that from the SEC filings is a massive sigh of relief for institutional investors.
It buys them time, certainly, but the new capital structure they agreed to in order to survive is incredibly heavy.
What are we talking?
They secured a $675 million senior secured term loan B, issued $345 million in 6.5% convertible notes, raised $115 million in fresh equity, and established a $500 million revolving credit facility.
We need to dissect that term loan B, because the terms on that specific piece of debt are punishing.
Extremely.
It carries a 15% annual coupon. On a $675 million principal, that is a staggering amount of cash just going out the door to service interest.
Brutal.
It also features a 100% excess cash flow sweep, and it hard caps their capital expenditures at $100 million annually for both 2027 and 2028.
Let's break down the mechanics of that 100% excess cash flow sweep, because it really dictates how the company operates for the next 2 years.
Walk us through it.
It means that every single extra dollar Sable generates from selling oil after paying basic operating expenses and their mandatory debt service cannot be distributed to shareholders.
Right.
It can't be used to drill aggressive new exploration wells. Every surplus dollar is legally swept directly into the lender's pockets to pay down the principal of the loan. It completely stifles their ability to grow.
You know, CFO Gregory Patronly had a quote on the call that summed this up perfectly. He told analysts, quote, "The hardest parts are takeoff and landing. Right now, we are on the ascent."
Yeah,
I look at this term loan B like a corporate payday loan.
that's exactly what it is.
It is absolutely necessary to keep the lights on today, but carrying a 15% interest rate and a 100% cash sweep means your only corporate priority is paying it off the very second you can.
Patronly knows exactly how precarious this window is. Management has a very rigid two-step roadmap to get out from under this debt.
Step 1.
Step 1 is surviving the immediate restart friction and securing a full 3P reserve report in the first quarter of 2027.
Let's clarify the mechanism of that report for everyone. Why a 3P report specifically?
In the oil industry, a 3P reserve report calculates proved, probable, and possible reserves in the ground, audited by an independent third party.
Right.
For Wall Street banks, a clean 3P report showing steady production is the gold standard. It proves the physical asset can generate reliable, long-term cash flow without massive, unexpected capital injections.
So step 2 is taking that shiny, freshly audited 3P reserve report, walking it back to the traditional debt markets, and refinancing out of this predatory term loan B.
Exactly.
They secure cheaper, standard corporate debt, the 100% cash sweep vanishes, and suddenly they can unlock those massive cash flows for shareholder returns, like dividends or buybacks.
That's the playbook.
But wait, this whole strategy hinges on the broader macro environment playing along? I mean, is management's Q1 2027 refinancing timeline too optimistic if oil prices suddenly dip?
It's a huge risk.
If Brent crude drops to $50 a barrel, their cash flow plummets, their reserve valuation shrinks, and their ability to refinance that payday loan completely evaporates.
If we connect this to the bigger picture, management actually anticipated that exact vulnerability, and they've actively insulated the balance sheet against it.
How so?
In July, they locked in a very specific commodity hedging program. They instituted Brent costless collars with a hard floor of $65 per barrel for 100% of their proved developed producing or PDP volumes.
Meaning they essentially insured their downside. And instead of paying out of pocket for that insurance, they funded it by selling off their upside exposure above a certain price.
Exactly. It's a brilliant, cost-neutral safety net. By putting a $65 floor under every flowing barrel through 2028, they mathematically protected their fragile refinancing timeline.
Got it.
Even if the global oil market crashes tomorrow and Brent drops to $40, Sable knows the absolute minimum amount of cash they will generate. It guarantees they can walk into a bank in Q1 2027 and show steady, reliable revenue to secure that refinancing, regardless of global macro volatility.
Okay, so the financial defense is firmly in place. But that $65 floor doesn't solve the fact that they still have to physically push those barrels through a choked California market to realize the cash.
No, it doesn't.
They still have to prove they can sell the oil without eating $30 discounts. So let's look at the two major escape hatches management detailed to bypass these regional onshore bottlenecks entirely.
If you're sitting in the C-suite, you simply cannot leave the fate of a multi-billion-dollar reservoir entirely in the hands of a few constrained California pipelines and rigid refinery schedules.
Definitely not.
You have to build optionality into the business model.
Well, escape hatch number one is the near-term solution they floated, the potential declaration of a California Strategic Petroleum Reserve, or SPR.
Yeah.
CEO Jim Flores seemed incredibly optimistic about this happening. He told analysts an SPR designation could theoretically materialize this fall.
An SPR designation would drastically alter the playing field.
Oh.
If the federal government steps in and declares a strategic petroleum reserve in California, it grants the Department of Energy federal authority to mandate the connection of currently isolated pipelines.
Oh, wow.
It's a national security play. It allows the federal government to essentially override the local friction and force the debottlenecking of the onshore market to ensure energy security for the West Coast.
And then you have escape hatch number two, which is their long-term structural play.
The buoy strategy.
The buoy strategy. This is a proposed $125 million capital project to install an offshore oil sales buoy by 2028, located right near Platform Harmony.
The buoy strategy is the ultimate bypass.
Yeah.
Mechanically, if they build this offshore buoy, they can load their crude directly from the production platform straight onto massive marine tankers sitting in the ocean.
Just skip the land altogether.
Exactly. They would completely circumvent the onshore California pipeline network, completely bypass the localized refinery monopolies, and suddenly they're selling their crude at global waterborne prices to anyone, anywhere in the world.
So what does this all mean for the stock today? Because I have to challenge the reality of this buoy strategy.
Okay, lay it on me.
We are talking about building a $125 million offshore crude loading buoy in heavily regulated California state waters. The permitting alone sounds like a decade-long nightmare.
It's definitely an uphill battle.
Right. Is this actually a realistic near-term solution? Or is this just a shiny object management is dangling in the earnings presentation to keep retail investors from selling the stock while they navigate a very bumpy 2027?
This raises an important question about how seriously we should take management's forward-looking statements.
Yeah.
But if you dig into the dense SEC filings regarding that debt restructuring, there is a specific detail that proves they are dead serious.
What was the detail?
When Sable negotiated that brutal term, Loan B, the one with the strict 100% cash sweep and the hard $100 million cap on annual CapEx management explicitly fought for and won, a $150 million carve-out specifically allocated for this buoy.
Oh, wow. You do not waste leverage fighting for a $150 million carve-out and a 15% interest loan unless you fully intend to deploy that capital.
Right. It proves management views bypassing the onshore California market as an existential necessity for the business, not just a luxury to appease shareholders on a call.
Yeah, that's a structural pivot.
They are legally and financially preparing the groundwork to build it if the state's onshore bottlenecks aren't resolved.
It shows they are aggressively playing chess with the physical infrastructure,
Yeah.
while Wall Street is just looking at the quarter-to-quarter financial checkers.
And that leads to a much larger dynamic that you really need to mull over as Sable's story unfolds over the next few quarters. Let's assume Sable Offshore successfully proves this massive 77,000-acre asset can operate at a steady state. Let's say they actually managed to generate that projected $500 million in free cash flow, despite all of the state's logistical hurdles.
Right, they pull it off.
Do they immediately become an irresistible acquisition target? Think about a super major oil company with a pristine balance sheet.
Yeah.
They could swoop in, absorb Sable, instantly refinance that predatory debt at a fraction of the cost, and take ownership of a world-class reservoir for a bargain.
It makes a lot of sense.
Or, on the flip side, is the regulatory complexity of operating offshore and onshore in California so uniquely high and so politically toxic that the supermajors will just refuse to touch it.
Forcing Sable to navigate this logistical nightmare alone indefinitely.
Exactly.
That is the multi-billion-dollar question. And navigating that exact kind of noise, separating the physical reality of an asset from the terrifying financial headlines during earnings season, is exactly what we do here. If you want to keep cutting through the static of the market, make sure you follow the show for our daily earnings coverage.